Welcome to the BrightWord Books Podcast. BrightWord is a leading platform for diverse storytelling, where voices from all backgrounds can share their unique narratives and connect with readers from around the world. Follow our regular podcast updates, where we strive to foster a literary community that celebrates creativity, inclusivity, and the transformative power of literature. Welcome to the BrightWord Books Podcast. I'm John Lobb, and I'm thrilled to be joined today by Ken Trester, author of The Complete Option Player. This book is one of the best-selling options book ever, and in his newly updated classic, he'll show you how to play the options game, where profits of 100% or more are not unusual. As you may know, an option is the right to buy or sell a stock or ETF at a specific price within a specific time frame. To be sure, lottery-like returns of more than 10,000% are possible. But for those who are more conservative, they'll be glad to hear that options involve a small price tag. Ken, welcome to the program. We're so pleased to have you with us today.
Good. Nice to see you, John, too.
Well, thank you. And sure, our audience will be wanting to learn more about this intriguing topic of options. Tell us, I know The Complete Option Player became one of the best-selling options book of all time. What inspired you to first write it, and what was happening in your life at that time?
Well, I wrote the book after I had discovered options in 1973, because that's when the listed exchanges started. And so I've been writing about options ever since and writing many newsletters in the
Wow, that's a lot
process.
of experience.
Yeah. Yeah, 50 years ago.
Wow. I bet you have seen some changes in the securities markets in that time frame.
Well, there's been many more options now. Almost every stock has options. Before, we only had 8 stocks when we started, and now we have many, many, many more. So it's really expanded over the years.
Excellent. And Ken, for our audience that's not familiar at all with the concept, I explained about the right to buy or sell. Can you go a little bit deeper in terms of understanding what exactly is an option and why would I be interested in acquiring one?
Okay, an option is like a side bet on what you want to do with a stock, but it's a side bet either to the upside or the downside. A put is the downside, the call is the upside, and you can play with stocks by buying options or selling options in that process. Okay, but the one thing I want to begin with right at the start, and I'll say it again later on, but 80% of all options expire worthless. Okay, which means that the money you bet is going to disappear basically, and by what we call the expiration date. Every option has an expiration date. Okay, which means that, for example, you may be looking at options on one stock and it expires in November or in October. You never know it exactly, but everybody has option has expiration dates each month.
Gotcha.
Okay, so you have to remember that. Okay, and 80% of all options expire worthless. Remember that too, which means that when you're buying options, you got to be very careful because most of your options are really bad bets. Okay, and
Absolutely.
an option,
If someone's considering options, it sounds like it would behoove them to do some research, including reading your book.
that's correct, exactly. But the key is remembering that an option expires 80% of the time worthless. Okay, so you want to buy options that are very cheap, and you want to be we can also you can also sell options, which means you can take the bet instead of making the bet. And when you do that, you have a much better advantage of winning. So it's better to sell options than to buy them. But for most people, they want to only buy them because it's much cheaper to do that. Okay,
Gotcha.
so that's the real key. So what you have put options, which are bets that a stock's going to fall in price. Call options are a bet that a stock's going to rise in price. Okay, so Um, there's many ways of playing options, but the real key is that you can get into options for a very low price. You can pay an option for as little as $1, and that controls 100 shares of stock. So you can make fantastic gains at certain times. For example, in 1987, I recommended in my newsletter an option selling for $6 Okay. Within just 3 weeks, the option went from $6 to $1,800, which is a very
Wow.
fantastic gain.
Wow.
Even just about a month ago, I recommended an option on a stock called QS, which makes batteries, and the stock went up from you could have invested $1 or $100, in other words, and you could have got as much as $700 within just a few days.
Wow.
So there are ways of making very large amounts with options, but when you're buying options, you got to remember most of them expire, so therefore you have to buy options that are cheap. Okay, you don't want to pay a lot of money for an option. You want to buy options that are cheap, and you want to write or sell options that are more expensive.
Got it.
And the key with an option is by writing a put, you are trying to buy at a lower price. When you do a call, you're trying to do something at a higher price. You want to buy or get out of a stock at a higher price. So there's advantages both ways. But the key is that you want to make sure that when you buy options, you're buying very cheap options.
Absolutely. It sounds like you would say, don't be playing with money you can't afford to lose.
That's exactly right. Exactly. And that's the beauty of options. You can buy options for prices that are unbelievable. But the key is you have to either buy cheap options or buy spreads. And spreads are where you buy an option and sell another option above it, but that reduces the cost of the option that you're buying. So you want to be buying spreads and you want to be writing options that are overpriced. Okay. And
Got it.
in my book, you will see a table on telling what an option should be worth.
Got
Okay.
it. Got it. So your book came out in the early 70s. What inspired you to update and re-release here in 2025?
Well, because there are so many more options added right now, you could do many more things with them. You can do spreads, like I said, or you can write options at much lower prices, so that you can generate a lot of income from whatever you're doing when it involves options.
Absolutely. Got it. Got it. One of the compelling ideas in your book, Ken, is the fact that the mathematical measurement of an option's true worth. And you mentioned that an option has this measurement that other securities don't, including gold and other stocks. Can you elaborate on that a little bit?
Sure. An option has an expiration date. That's a date when it expires, which means it becomes worthless, except if it's in the money. And if it's in the money, it is what is called the strike price. And the strike price is a stock price. Above that price, for example, your option is worth $100 per point. So if it's at 5 or 6 points, that's $600. But if it's below that point, at that point in time, that option becomes worthless. That's why 80% of all options become worthless. So you're really trying to bet on an option going into the money or across the strike price. And that's the stock price that you bought it at. So you're basically, it's a mathematical calculation. How long will that option have before it expires? And also, how long does it before it expires? And of course, what is the strike price or the expiration price of that option? So that's what you're always aiming at, expiration and time. Now, when you're buying options, you want as much time as you can find. And when you're selling options, you want as little time as possible before it expires.
Got it.
Okay. And again, remember when you are writing options or what we call selling options, you are basically trying to get as little time as possible where you hold the option because you are short. You're the person taking the bet. So you don't want to have that bet very long. And when you're buying options, you want to buy as much time as you can find. So you want to get an expiration date that is much higher or a strike price that is much higher.
Got it.
Okay.
So that really is different from just buying a stock and saying, gee whiz, I hope that it'll go up at some point in time. With an option, whether you're buying or selling, you know the start date and the end date, and you have this finite amount of time that you're working with that you don't in other kinds of trading.
That's great. That's right.
It's
So
a different
therefore,
dimension, if you will.
If you're buying very short-term options, you want to be the seller. You want to be the person taking the bet instead of making the bet. Okay. And when you're buying options, you want as much time as you can buy before the option expires. So it gives you enough time for the stock to move to the point you want it to move to. But
Got it.
the beauty is you can buy options for very low prices. They might be long shots, but they don't cost you very much money. I'll give you
Got
some
it.
examples. I have a newsletter right now, and we recommended a set of options, what we call an option spread, but it only costs you $30. That's what it costs you. And if it goes up another 5 or 6 points, and that's Intel, by the way, you would make $600 or $700 for a
Wow.
$30 investment. Okay. And just like with my example in 1987, you could have bought a cup of coffee for what it would cost to buy an option. And that option went to $1,800. So
Wow.
you can make very big gains. But again, you got to be careful and only pay very little price for the ones you buy and get a lot of money if you're going to be writing them or taking the bets.
Absolutely. Absolutely. So almost like an oil well, you never know when you'll strike oil,
That's right. Exactly.
but as long as you're mentally prepared for as high as 80% of the time, you won't win on that small bet. But the bets that
Right.
pay off, and I imagine you've had some bets pay off over these years, so you've
Oh,
stuck
yeah.
with
So
options as a fan.
just a month ago, I recommended a call option on QS, and that's a company that produces batteries. And I recommended it around $100 for the whole option. That's you pay $100, you control 100 shares of stock, and that option went from one to about $600 or $700.
Wow.
Just and
Wow.
then, but then you had to take profits quickly because remember, options expire and they will disappear. So you want to make sure
Absolutely.
you want to always be making sure that you are paying small amount for buying them and selling them, of course, when they get much more expensive.
Absolutely. Well, it sounds like your subscribers to your newsletter, got a hot tip there for sure.
That's right, exactly. But I'm always looking for opportunities like that.
Ken, what are some of the most common mistakes that beginners make when it comes to options?
They first of all pay too much for them. Okay, if you're going to buy an option, don't pay a lot of money for it. You try to get a small amount of money as you can, and then try to take profits very quickly, because options expire after a certain time, and you have to act very quickly to take profits. Okay, and then you want to, of course, if you are a writer, different story. With a writer, you want very little time left, and you want to get as much premium as you can, or what we call it premium, the cost of the option.
Gotcha.
But again,
Gotcha.
remember the option has a certain amount of time and it has a certain strike price. So you want to get when you're buying options, you want to get as close to the strike price as possible. And when if you're selling options, of course, you want to have as little time as possible before that happens. But if you're buying
Absolutely.
options, you want as much time as you can get. Okay.
Got it. Got it. So that time frame that we talked about, the whole idea of options, a key element is that there's a start date and an end date. You've got to be aware of that, and you've got to manage to that as well,
That's
whether
exactly
you're
right.
buying or selling options.
Right.
So
Yeah, you just don't want to
interesting.
go out and buy an option. You want to really make sure that it's if it's a buy you're buying one, buy as much time as you can get as close to the strike price as possible. And again, if you're writing options or doing the other side where you're taking the bet instead of making the bet, you want as little time as possible and you want to be as far away from the strike price as possible. So what you do if you're a writer, and that's by the way where most professionals make their money, and is taking bets instead of making bets. And they basically are trying to get as much money as quickly as possible and then closing the position out.
Got it. And it sounds like they're well aware of that 80% number, and they intend to make their living on that 80%
That's
that
right,
expire.
exactly. Yeah. Because again, remember, 80% of all options expire worthless. So you got to be very careful when you buy options. But there's one other thing you should think about, and that is spreading them. Because there are so many options out there now, you can spread it buy the option and then sell another option against it that reduce the cost of that option maybe 50%. So you're making a much lower price off for the risk you're taking.
Absolutely. With recent events, Ken, for example, the tariff announcements caused a lot of gyration in the markets, and we saw the Dow dip 500 or 600 points and then recover 800 points, kind of going crazy.
Right.
Was that an especially interesting time for those who dabble in options?
Oh yeah, you want as much volatility as you can find. That's right.
Okay.
So you want as
So
much.
that was actually it was great times for
Oh
options.
yeah, it's always a great time for options. Okay, what you want as much movement as you could find. Okay, so because that generates much better returns.
Got it. Got it.
Just like with QS, it just went up to 700%, just like that.
Absolutely.
And like I said, and
Would the thinking be similar, Ken, if you have a company, let's take Microsoft, right? If you believe that Microsoft is a solid company, profitable and doing the right things with AI and so forth, if you believe in the company and through some gyrations of the market, it's essentially on sale for 10 or 15% off because the market dips,
right,
you could buy it and pay whatever Microsoft is running at, let's say, to get 100 shares. Or it sounds like for a smaller investment, you could buy an option to buy Microsoft at the lower price in the next 6 weeks, for example. Is that a valid example?
it's a valid example, but remember, spread it instead of buying it, which means buy it, but then sell an option that's further out, which gives you a lot less premium. It reduces your cost about 50%. 50%. Okay.
Wow. Okay.
So,
Okay.
if you want to play Microsoft, that's the way to play it. Buy an option, but write an option against it to reduce the cost of that option. That's the key. Is you have to spread it,
Got it.
and
So
that's what
are you
my book
saying
does. That
to buy one option and also buy a sell option
sell an option against it. Which,
against it?
for
Got it.
example, if a stock is going for $30 a share, you would buy the 30 call, but then you would sell a 35 call to offset the cost of the 30 call, and that reduces the cost of that thing. Now
Got it.
it goes above 35. Well, you lose some opportunity, but you made a lot of money before that happened.
Got it. Got it. So you have the opportunity to make a lot of money and maybe more likely lose money, but not lose as much as you would have made.
And that's correct, and you can actually participate because you're betting on 100 shares of stock, and that's a very big that's a big amount of money you don't have to invest in.
Got it. And would that be related, Ken, to this theory of portfolio insurance? In other words,
Yes, yes.
guarding against losses. Is that how that works?
Well, guarding against losses, I would suggest buying very very cheap puts. Okay, because a put is a stock, a bet that a stock's going to fall in price, and if you buy a very cheap put and the stock falls, you could make a lot of money when it fell. Just like that example in 1987, where the stock went from the option went from $6 to $1,800. That's what happens. And what you do is you protect your portfolio by buying cheap puts and buying
Got
again
it.
as much time as you can find, but paying as little as you possibly can for that
Got it.
option. So just remember that 80% of the time the options will expire, but by having these puts, you got kind of insurance in case something does go wrong.
Absolutely.
And so this might be a good time to start thinking about buying puts or put spreads. Okay, reducing the cost of the put. So that's always the key: is reduce the
And
cost of
not
the
with
put.
low quality equities either. It might be a company that you firmly believe in, but you believe that the price has just run up too high
That's right,
and you
exactly.
want to guard those gains that you've made.
That's right, and that would lock it in. So you want to buy puts to protect yourself, but you want to buy them cheap and out of the money, so that it has to the stock really has to fall to get the put to go up in value. But because now that the markets are so fluid, and every day a put will expand, even if it never gets to the strike price, because everybody's fearful that something's going to happen bad. So the premium goes way up. Then you can take your profits and run.
Got
Okay.
it. Got it.
So the beauty is, and of course, if you're trying to buy stock, you shouldn't buy stock. You should write puts. Okay, write puts, which means that you're taking somebody's money, and somebody's paying a lot of money to protect himself, but you're taking the money as kind of like a cushion. But when the option expires, which most of them do, you keep the money.
Got it.
So you have a put
Got it.
that's going for $200 or $300, and the stock never gets down to the strike price. You just keep the money. And if you're
Got
doing it
it.
on a short-term basis, a very short-term basis, you can make a lot of money doing that. And that's
Wow.
so therefore the real professionals that I know are always writing puts or writing calls. They're not buying stock. They're just taking money that people are kind of
Willing to put up.
willing to hedge, so they're hedging. But you're keeping the money and you're trying to buy the stock. So if you eventually get the stock, that's fine. But if you don't, you keep the money. That's the
Wow.
key. Okay. And
Wow.
that's what most professionals that I know, that's all they do. They just write puts.
Wow.
So they're just, and the thing is, you always want to write a put when there is panic in the market or there is panic in the stock. So when a
Hmm.
stock goes down 15 points, then you start writing puts, but far out of the money, far away from the strike price, so that you don't
Got it.
ever have to get the stock or anything. You just keep the money. So it's like somebody, you're just picking money out of the market, basically.
Absolutely. Well, you know the old saying about the market that the only two things that drive it are fear and greed.
That's right, right. And when there's fear, you make a lot of money writing puts. Okay, because you're taking the money that somebody wants to bet. Okay, so they want to
Absolutely.
buy the put. You're taking the money, and if the stock ever gets down that low, you can buy it, but you don't have to. You can always close it out at any time, and that's the beauty of options today because you have listed mark. You can close out positions whatever you want. If you don't like the risk, close out the position, and
Got it.
that's the big thing today.
Over the years since the 70s, you've taught thousands of readers and investors, and you've met thousands of people, I'm sure, and a lot of pros. Is there one thing in common that everybody who does well shares?
Well, being very cheap, you don't want to pay a lot of money for risking anything, but at the same time attempting to take the advantage of fear and using it to your advantage. So if there's a lot of fear in the market, you'll love it. And if there's a lot of greed in the market, you want to be selling positions and not buying them. So you just
Got it.
basically got to use the psychology of the market. But the put writers that I know were always very professional about waiting for panic and then writing puts or writing calls. Even now, I'll give you an example. A recommendation I did yesterday. It was on IWM, which is the Russell 2000, and I just wrote a put. It only has a week left. I'm sorry, I wrote a call. I wrote a call, has a week left, but it's never gone above that price in the last 9 months, which
Wow.
means the odds are in another week I'm going to keep money. If you see what I'm saying.
Absolutely. Absolutely.
So
Because you know
always,
what others don't.
that's right. And you look at the charts. Make sure that when you're doing something, make sure that it never has gone to that point before. So you're using the fear of the market basically to take positions.
Absolutely. And you talked about the various new options that have developed over the years. Has that really what's informed your own style when it comes to
Well,
puts?
there's a lot of options on the commodities. For example, if you're betting on gold, silver, platinum, you can take option positions in those things. And that's what I do. I do a lot of call buying and those kind of things. But I always do spreads, which means that I'm buying a call option, but I'm also writing another call option to reduce the cost of that one. And that's further out of the money.
Got it.
So basically, because now you can almost buy options on almost anything, you can do these things to create good opportunities.
Absolutely. Absolutely. If there's one thing that you would hope that a reader takes away from the complete option player, what would that be?
Well, the fact that 80% of all options expire worthless. So you want to
Okay.
make sure that you're taking low priced positions. Make sure that the price is always key, and you want to pay very little for that price. Okay, that's the real key. And
Got
again,
it.
remember time and strike price. Those are the two things you're looking at. And if the time is very small and you have an option position, make sure it's a writing position, not a buying position.
Got it.
Remember what I said before. 80% of all options expire worthless. Okay, which means that you don't want to be doing things that are not involving just buying options, unless they're very cheap.
Got it. Got it. So I think bottom line is do your homework. Be an
Exactly.
informed investor.
Yeah, and always look at the charts and make sure that you're doing things that would not be violated if you're writing, but if you're buying, you want to make sure that it could hit that position within a certain amount of time. Again, the
Got
time
it.
is always the key. So when you're buying, you want a lot of time. When you're selling, you want little time.
Ken, do you have any predictions for where the stock market will stand at the end of 25?
I think it will be higher. I think it'll
Okay,
be
so you're
higher.
an
And
optimist.
I'm an optimist, and but I think one of the major reasons I believe that is because the debt in our country is so large that the U.S. dollar is going to go down in value, and that means that the industrials and all the companies are going to go up in value. So that's why I'm much more bullish. But
Gotcha.
I have another book which is called Investing in an Era of Power, Control, and Corruption. And that one really goes into how dire our situation looks. So you may,
Wow.
and then of course covers options in there, but that's what it is.
Wow. Do you think our national debt is the big ticking time bomb that people speak of?
Yes, it is. It is definitely $37 trillion. We're never going to pay that back. And every republic lasts around an average of 240 years. And we are now almost into our 250th year. So that is not a good sign. The picture does not look very pretty. So that's why, you want to use options as a way to offset some of that risk. And you want to try to find those black swans, which are events that are not predicted, because that causes severe sell-offs or rises in the market. And there you want to take advantage of those kind of turbulent times, because that makes much bigger opportunities.
Sounds like whether the market is going up or whether it's going down, you can make a profit. You can make some money if
Oh
you know what you're
yes,
doing.
that's right. Yeah, with options you can make money all the time. And just remember that.
Never a bad season for
It's never a
options.
bad season for options. That's right. Even when you think
Terrific.
it's quiet, there's always going to be volatile times ahead. So therefore, you want to take advantage of that. But you're always looking for opportunities, and opportunities occur when there's panic in the market or when there's extreme turbulence in the market.
Well, Ken, it's been a wonderful visit with you. Thank you so much for sharing your thoughts and educating us all a little bit more on the world of options and the
Okay,
advice that you give, especially to those of us who are outside of that world and have heard things about easy money and lottery like returns. It sounds like they're certainly available, but
they're
proceed with caution.
very good. And if you can check out our website, it's called optionbooks.com.
Optionbooks.com.
Yeah.
Terrific. Well, thank you so much. And for our audience, thank you for joining us today on the BrightWord Books Podcast. We've been visiting with Kenneth Trester, author of The Complete Option Player. And I assume that's available on Amazon and Barnes & Noble,
Yes,
everywhere
it
fine
is.
books are sold.
Yes, it is.
Excellent, as well as your own website.
Yeah, exactly. Okay.
Terrific. Ken, thank you so much for being with us.
Okay, thank you, John.
You've been listening to the BrightWord Books Podcast, home of the literary community that celebrates creativity, inclusivity, and the transformative power of literature. Don't forget to subscribe so you'll never miss future episodes. Until next time, stay informed and stay engaged.